Hey everyone, there's a hidden risk when investing in SoFi stock that I wanted to share with you in this video so that everyone is aware what you're getting into with SoFi stock. Now, that being said, this video is not meant to discourage you from investing in SoFi stock. It's just meant to make you aware of the risks apparent in SoFi stock. In fact, I have SoFi stock rated as a buy, but even stocks that I have rated as a buy, I like to look at the bear case scenario, the worst case scenario. What are the risks? Because as always, investors must consider investing is a two-sided scenario. There is risk versus return. And so you've got to consider the risks in order to decide if the potential upside is worth the risk that you're taking. So let's take a look at the risk I'm talking about. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so the risk I'm going to talk about has to do with SoFi's exposure to loans, but let me build up into it so that we get a fuller picture of what I'm discussing here. So SoFi likes to boast that their customers have very high credit scores, and they're saying that their personal loan borrowers have an average income of $169,000 with a weighted average FICO score of 746. But why are they giving you this information? They want you to believe that their personal loans that they're making are not with risk or with lower risk because the people that they're lending to make a lot of money and they have a high credit score. They're trying to convince you of that fact that, oh, we're being prudent with the lending that we're making because we're choosing very high quality borrowers. And that is true. That is true because you can see that with the data. They're being selective with the people that they're giving loans to. Now, you might say, well, what do they do with the people that they don't approve for loans? Well, SoFi has an interesting way of monetizing that as well. I won't get into that too deeply, but they can refer those customers to other lenders that might be more willing to lend to lower quality borrowers. And so SoFi will refer those borrowers to someone else, and SoFi will keep the highest quality borrowers for itself. So their student loan borrowers have a weighted average income of $146,000 with a FICO score of 768. Now, this is a bit misleading, right? When you look at student loan borrowers, the FICO score of 768 is higher than a FICO score of 746, but typically student loan borrowers are much younger and have much shorter credit histories. And so you don't really know if they're a better risk in terms of lending versus lending to somebody that's, a bit older, has more history, has been through a couple of economic downturns in their lives and knows how to deal with those situations. Whereas you don't know how these younger borrowers will deal with an economic downturn. Have they positioned themselves balanced enough to be able to deal with the downturn? You don't have that information yet. But the FICO score suggests that they are a better risk. And that's partly one of the downsides of using FICO score to measure credit risk. Okay, so now let's get into the meat of the situation. When SoFi makes loans, they have a choice to keep those loans on their balance sheet or to sell those loans to another investor. When they keep the loans on the balance sheet, SoFi is exposed to delinquency. If someone does not repay that loan, SoFi's on the hook. They're going to lose that money that they lent out. But SoFi can also choose to sell that loan. If SoFi makes a loan, it can immediately sell it to another investor and get back its money that it lent out. And now the other investor is on the hook for recovering payment from the borrower. And SoFi will do that sometimes because it can make a small profit from the fees it charges to make those loans. And then it can sell the loans for a small premium and make some money in the quick term, in the near term, rather than waiting to collect the payments. So they did a lot of that in the last quarter. They sold over $1.9 billion of loans, and 1.26 billion of that was in personal loan, 300 million was in student loan, and 350 million was in home loan. Now, of these three categories, personal loans are the most risky. I've talked about that extensively in my videos about SoFi. If you lose your job, the first loan that you're going to default on is the personal loan. You're not going to default on your home loan. That's the last one. You're not going to default on your car loan. That's the second to last one, because if you miss those payments, they're going to come and repossess your home and your car. Your student loan will be before those. And then your personal loan will be the first one, because the only repercussions for missing your student loan payments, your personal loan payments, is that it will hurt your credit score. But they're not going to come and take your home away for missing on your personal loan payments. So those are the riskiest. And you can understand why SoFi sold a larger portion of those than any other loans. They want to de-risk a little bit. But in terms of these personal loan sales, they had a blended execution of 105.7%, meaning that if there was a nominal value of 500 million, they sold it at a price above 500 million. And investors are willing to pay a premium for certain reasons. Number one, they don't have to do the work to make the origination of the loan. They don't have to work to gain that customer. And number two, SoFi is giving some benefits to this borrower. Let's take a look here. So these had similar structures to other personal loan sales, with cash proceeds at par or a small premium to par. Par means just the face value of the loan. If they make $100 million loan and they sell it for $100 million, that's par value. It's equal. And these majority of loans consisted of contractual servicing fees that are capitalized. So SoFi is telling this investor, hey, we'll communicate with this borrower and we'll collect payments for you. And for that service, we'll charge you a small fee. And the lenders sometimes agree to that. And these deals also included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would have otherwise if we held the loans. And therein lies that hidden risk that I was talking about at the beginning of the video. That's the hidden risk with SoFi stock. These loans that they're selling and presumably moving it off their books and thereby de-risking, right? Because they no longer own these loans and they're no longer on the hook, so to say, for defaults. But they are, because these sales include a provision that says if these loans default, we are on the hook for a small share. So we still have to pay, we still have to take losses if these loans default. So they're not completely off the hook for these billions and billions of personal loans that they have sold in the past. And they did this again in the latest quarter. You saw management saying that these are similar structures to other sales, and they include a loss share provision. So if there are massive defaults in the personal loan portfolio, it's going to be large for SoFi. It's going to be meaningful. It's going to hurt the business, because not only will they suffer losses on the personal loans that they have on their books, but they're also going to have to pay these investors that they agreed these loss share provisions. So this is a hidden risk that I just wanted to make SoFi stock investors aware of. Now, I'm not trying to scare you away from buying this stock. As I highlighted earlier in the video, I have SoFi stock rated as a buy, and I last updated that recommendation on May 13th. So even considering the risks associated with SoFi stock, I still think the upside is worthwhile. But still, I like to go into every investment with eyes wide open and aware of the potential risks, and that's one that I wanted to make you all aware of. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.